What if I told you there's a simple indicator that can tell you when a stock or a forex pair or whatever is about to reverse direction? Today we're diving into RSI, one of the most popular tools in day trading. Whether you're a total beginner or more advanced, by the end of this video, you're going to know what RSI is, how it works, and how traders can use it to better inform their trading decisions. RSI stands for Relative Strength Index. Despite the name, it has nothing to do with comparing one asset to another. Instead, it measures the momentum of the price movements of an asset. RSI is almost like a speedometer. A car speedometer is going to tell you how fast it's going or how slow it's going. RSI is telling you how fast a certain asset's price is moving. That can be moving really quickly up, really quickly down, or moving much more slowly. Most importantly, RSI can tell you when an asset's momentum is running out of steam. RSI is what's called an oscillator, so it bounces back and forth between 2 points, 0 and 100. Most of the time, you're going to see RSI in between 30 and 70. These numbers are really important for knowing when to buy and sell an asset. So don't worry, RSI is not something you have to calculate by hand. It's built into every single major trading software. But understanding the basic concept is going to help you to trade it better. RSI looks at the last 14 periods. Could be 14 days, 14 hours, 14 minutes. It all depends on what kind of chart you're looking at. Then it compares the average gains during up periods to the average losses during down periods. So here's the simple version. If an asset has been growing and growing and growing, and by bigger and bigger amounts, the RSI is going to be higher. It's going to be getting closer to 100. If it's doing the opposite, and an asset's price is going down, and it's going down by bigger and bigger amounts, it's going to be getting closer to 0. The magic happens at these extremes. The closer RSI is to 100, the more likely it is to be running out of steam and start to go down again. The closer it is to 0, the more likely it is to start going back up. What a really high or a really low RSI is telling you is that an asset is potentially overbought or oversold. It means it moved to this price really quickly with a lot of momentum. Because of that, it's really likely to snap back. So something a lot of traders overlook is adding a moving average to their RSI. This creates what's called a signal line. This is usually a 9-period moving average of the RSI values. What this does is smooth out all of the bumps in RSI and give you a clearer picture of what's happening. You can also watch when the RSI line crosses the moving average line. That can be a bullish signal. When the RSI crosses below the moving average, that's usually a bearish signal. Especially when the market is really choppy, this signal line can give you a lot of clarity in the market. A lot of traders wait for an RSI level signal as well as a moving average cross before they consider getting into a trade. Okay, here are the RSI key levels to keep in mind. If the RSI is over 70, most people consider that overbought. This doesn't mean you should immediately sell, but it is a good warning sign. In the same way, if the RSI is below 30, we usually see that as oversold. Again, you don't want to go in and buy right now, but that's a good sign to keep an eye on this asset. If the RSI is around 50, it's a very neutral zone. Usually here the price action is really choppy, there's not a lot going on here. And here's a really key point. Just because the RSI is over 70 or under 30, that doesn't mean that price is immediately going to snap back. Price could keep moving for a long time with a lot of momentum. You pretty much never want to trade RSI levels by themselves, but they're a great indicator to look at along with other signals you're getting. So here's an overview of a couple of really simple strategies that people use with RSI. RSI divergence. This is a really powerful setup. Basically what happens here is price makes a new high or a new low, but RSI doesn't show that. So price is really overextended in either direction, but RSI hasn't confirmed it yet. What this suggests is weakening momentum and a potential reversal. Our second simple strategy is RSI overbought and oversold reversals. This one is really simple. You're going to wait for RSI to go above 70 or below 30. What that tells you is that the price is overbought or oversold. And then you're gonna wait. You're gonna wait until RSI comes back down under 70 or back above 30. And that's when you're gonna put in your buy order or your sell order. What this shows you is that price has overextended and now it's starting to reverse. The key here is waiting for confirmation. Don't sell just because the RSI has gotten over 70. You wanna wait for the RSI to go above 70 and then go back below it again. Finally, RSI moving average crossovers. This is how I like to use RSI personally. You're going to wait until RSI is either overbought or oversold. So over 70 or under 30. Then when you're in that condition, you're going to wait for your signal line to cross your RSI line. This can signal a really strong setup for a reversal. So quick pause. If you're enjoying the video so far, I'd love it if you could give it a like. If you want to see more content from me, you could subscribe. Okay, so let's get back to it. All right, now some common RSI mistakes. The first one is trading RSI signals in isolation. This is true for almost any indicator, but you should pretty much never just jump in on a trade because of that one thing. This is true for basically every single indicator, but the rule is one signal is almost never enough for a trade. Just because RSI goes over 70, just because you see moving average cross, doesn't necessarily mean this is a good opportunity. You're going to want multiple things to confirm your setup. Look at price action, support and resistance, overall market trend. All of these things can confirm your setup. Mistake number 2. Assuming an extreme RSI level means an extreme reversal. In a strong trending market, RSI could stay overbought or oversold for a really long time. You really want to wait for confirmation that that momentum is changing before you try to trade a reversal. Mistake number 3 is ignoring market context. RSI is going to work differently in trending markets versus a consolidating, choppy market. In a trending market, it might be leaning towards 40 to 80 all the time, or 20 to 60 if the trend is down. In a choppy market, it might be going between 30 and 70. You have to keep all of this in mind when you're looking at RSI. RSI is a fantastic tool for day traders, and it's one of the most popular indicators out there. But like anything else, it's most powerful when it's combined with risk management and other forms of analysis. So start by just adding RSI to your existing charts and seeing how it behaves in your normal setups. If you like it, you could add it as a potential area of confirmation. Practice identifying those divergences and extreme reversals like we talked about. Obviously, do all of this with paper money before you get into trading real assets. I have lots of other videos on day trading basics. If you want to learn about the basics of moving averages or different types of candlesticks, click something on the screen. If you liked this video, again, I'd love it if you gave it a like. If you want to see more content from me, hit the subscribe button. Either way, my name's Andrew, and I'll see you around.